Welcome to Lesson 2, Mums, of Module 5, where we're talking about understanding your investment style. Now, investment style is important because it's attached to or dictates what investment types you will place your investments with. Now, as Carrie Bradshaw said, I like my money where I can see it, hanging in my closet. Now, when I talk about investment style, I'm not talking about what you spend your money on. I'm talking about how you invest, whether you're a passive investor or an active investor, and how that type of investment style dictates what kind of investments you should be looking at. So how do we understand your investment style? What is there to know about investing and style? There's basically two different types of investment styles. You can break investors into two categories, active investors and passive investors. So active investing is an investment strategy where an individual investor is more involved in the buying and selling of investments. Passive investors are essentially those people that make few transactions as possible and take a buy and hold approach to investing. So there are two ends of the spectrum there, and really it's about learning a little bit more about how they approach investing and what kinds of strategies and products they use before you can sort of determine what end of the spectrum you will sit on. Okay, so to understand active investors a little bit better, they are basically individuals who are more involved in the buying and selling of the shares or other investments in their portfolio. They ultimately believe that they have the knowledge and the skills necessary to beat the return of the share market as a whole. So they rely on their own investment knowledge and acumen to trade more frequently their investment portfolio in order to achieve a higher return. Now, this concept extends to a product level or a fund management level as well, with active portfolio management referring to a strategy where the investment manager makes specific investments with the goal of outperforming a benchmark index. So, to dig a little bit deeper, what do active investors invest in then? What kinds of products do they look at? They would typically invest in things like actively managed funds and direct shares. Now, just to cover off on what those investments actually are, managed funds are investments where your money is pooled together with other investors' money. So you don't own individual shares in the underlying investments, but rather you own units in the managed fund itself. And there's an investment manager that manages the portfolio, and he or she buys and sells investments on your behalf, and you are usually paid a distribution, which is a percentage share of the profits or returns, on a periodic basis, so either quarterly or biannually or annually. Now, direct shares, by contrast, mean that you own the individual shares of the company in which you invest. So what are the advantages of being an active investor? Well, basically it allows investors to quickly take advantage of market opportunities. So by buying into companies that they feel are undervalued, and they can therefore achieve a higher growth and return, and by selling those that they feel are overvalued, and then with wider market fluctuations and economic conditions that make certain investments more favourable. Also, it provides the potential for greater profits and returns than the overall market and index funds due to the opportunity to profit from the inefficiencies in the market, so seizing opportunities essentially. And then it also provides greater control over an investment, so you can buy and sell the investment at your discretion, which is something you can do more so with direct shares than managed funds, but ultimately it provides you with a greater level of investment control. On the flip side, though, there are some disadvantages. So there can be much higher management fees and expenses attached to the kinds of investments that active investors make. because the potential for greater returns essentially comes at a higher price. It also requires a time commitment to do your homework and research on the best options to get the best returns. And although there is the potential for overperformance, the investments can also still underperform the market due to poor investment strategy. Because wherever someone is actively selecting or cherry picking investments, there's always the possibility for those decisions to be wrong. So that is, in a nutshell, what an active investor invests in and some of the advantages and disadvantages of following an active investment style. On the flip side, let's take a look at passive investors, or at the other end of the scale. So again, passive investors are usually much less involved in the buying and selling of shares in their portfolio. Selling and buying transactions are limited in order to minimize transaction costs and tax implications. So generally speaking, they follow a buy and hold approach, seeking things like longer term capital growth with limited trading activity. Now, passive investing is often great for the beginner investor because it provides a broad level of diversification, which is an investment basic we talked about last lesson, with minimal costs. So let's look, what do they invest in? They invest in things like index funds and exchange traded funds. So to cover off on what an index fund is, an index fund is simply buys a portfolio of investments that copy or replicate an index, such as the All Ordinaries Index or the S&P 200 Index. Now, these indexes are simply a representation of a part of a market, so the stock market in this case. Now, one of the most well-known indexes is the S&P 200, which tracks the stocks of the 200 largest Australian companies on the Australian Stock Exchange. ETFs generate a return before fees that is almost the same as the index it's tracking. So index funds are traded directly on the ASX, just like direct shares. So to really be able to understand the differences or the benefits of being a passive investor, let's look at some of the advantages of purchasing this kind of investment option. So there's a much lower time commitment for research and investment management. There's less decision making required by the investor. There's much lower in certain cases, ongoing fees associated with these products compared to managed funds and direct share purchases. And there's also a certainty with regards to investment return, and that is that the investment will not underperform its benchmark. On the flip side, there are a few disadvantages to a passive investment style and the associated products, and that are that index funds will never outperform the market because they are constructed to replicate the performance of the market. And then the other disadvantage is that there's a lack of flexibility. You can't cherry pick your investments. An index fund replicates, as I said, a benchmark or in a market index, and therefore the construction of that index fund is already predetermined based on the benchmark that it's tracking. So there is no cherry picking of individual shares or managed funds as there is with active investing, but that in itself is where the lower time commitment for research and investment management comes in. So you might be thinking at this point, well, what describes me best? I'm still not entirely convinced I'm on one side of the fence or the other, or that I entirely understand where I should be investing my money and what strategy should I be following. So the good news is you don't have to be on one side of the fence or the other. A lot of successful investors utilize investments that fall under both categories. So they fall under active investing style and the passive investing style. And therefore they're essentially able to combine the advantages of both investment styles. So, as an example, your investment portfolio may have a selection of exchange traded funds, which are passive investments from the right hand side of the spectrum. And it may also have an allocation to direct shares, which are typically active investments to the left hand side of the screen. And they do that to provide themselves with exposure to the potential for higher returns, which comes from the active side of the investment style, whilst also providing some certainty with regards to returns and a lower time commitment to their strategy from the passive investing style of things. So you can be a bit of both. There's no requirement to be one or the other. So while both passive and active investment styles can be profitable, you need to know what kind of person you are to kind of decide how you'll construct your portfolio and with what investment styles. So start by considering what describes you best. If you have spare time, are highly competitive, you have a higher tolerance to risk, and you enjoy a complicated intellectual challenge, then an active investment approach would suit you perhaps better. If, on the other hand, you always feel rushed, you crave simplicity, and you don't relish thinking about money, then perhaps a more passive investment style suits you best. So both approaches are equally intelligent and a smart way to approach your finances, or your investments rather, and you can be successful with either, but only if you know yourself well enough to pick the right style, because you need to stick with it over the course of your investing lifetime and keep your costs and emotions under control. Because financial risk lies not only in our economy or our investment choices, but within ourselves. So the biggest threat, or one of the biggest threats to the performance of your investments are your emotions. A lot of investing professionals will tell you. And that is because people second guess themselves and they buy in and buy out based on emotion rather than an educated decision. So for most mums in this course, I would imagine that a passive investment style reflects who you are and where you're at in your life a little bit more than, say, an active investment style. Unless, of course, you have a really keen interest in investing and some additional time to spare, or are prepared to dedicate that additional time in your life to investing and skilling yourself in the strategies of active investment. So if you are a busy mum or a newbie investor or both, then an investment portfolio that takes a passive approach to its investment style is a really great place to start. You won't feel the time pressure of needing to watch and monitor your investments all the time, and feel the time pressure of having to make investment decisions on a regular basis. You won't feel the need to be the smartest person in the room all the time when it comes to investment decisions. And it's a really great way to make a start investing and watch how the investment performs from a distance, because there's no active trading, buying and selling required. And it's a great way for you to start investing while you're still learning. So don't let the fact that you are busy and finance is not your background deter you from making a start. Not everyone needs to be a stock picker in order to make money with their investments. Okay, the activity that goes with this lesson is a case study. It's a closer look at passive investment as a style. So if you're not clear on the advantages of a passive investment style and how it can really be a beneficial way to start investing for a busy mum, download the case study to take a closer look at passive investing and the investment returns that can be achieved on that kind of portfolio. Okay, next up, we're going to look at how to actually develop a personal investment plan. So we've looked at the basics of getting started, and then we've looked at what is your investment style and how does that determine what kinds of investments you might consider as part of your portfolio. Next lesson, we're going to look at how you develop a personal investment plan just for you. So hop on over into lesson 3. I'll see you there.